thunder is going away. Okay.
Okay, welcome everybody. Hope you all had a nice couple weeks off from class. We have Jimmy Lane here with us tonight. He is a top producing realtor in Key West. He's a friend of mine. We've been friends for a long time. He's a good guy. He's got a lot of awards and certifications. I don't know them all, but he's been on the board of the Realtor Association for a long time. He was president for a while. He's been on HGTV. I didn't see that on your resume. You should add that in there. Anyway, Jimmy knows what he's talking about, and he'll be able to answer any questions that you have. So he's going to go through his slides, and then he'll give you a lot of time to ask questions. Here's Jimmy.
Thank you, Hannah. Hey guys, so we have some future homeowners in here, hopefully. Yeah, has anyone here owned a home before? Nope, so we're all one person? Okay, so you've been through it a little bit. There's can be a tedious, complicated process, as I'm sure you're all figuring out. Seems to get more complicated as we go along. Seems like everything in life probably is something like that. So today I'm going to go through purchase process, monthly expenses, and closing costs. So I know you've had a series of other people speaking to you about various things. I don't know that you've had any real estate agents up here from that perspective, but I'll kind of go through the whole process with you. We're going to kind of focus on the expenses and closing costs part of it. So the first part will be kind of the process in general. I'll go through that a little bit quicker. If you have any questions, feel free to ask about those as we go through it. So obviously in Key West, major areas of concern, number one, obviously is affordable housing. That's our, as we see every day with our friends and neighbors that have to move away because the cost of housing is extraordinary and it seems to keep going up. Our market has seen at least 30% appreciation, if not a little more than that, depending on what part of the market at Key West or the lower Keys that we're talking about. And the last strategic plan identified housing as number one concern, even above sea level rise. So you're preparing to buy. First thing is you're going to start saving. So there's going to be, in just about any kind of purchase, there's generally a down payment or escrow deposit that has to be made. Earnest money is typically the first deposit that you put down when you go to buy a house. So that ends up being part of your down payment. And we also, another term for that is good faith deposit. So, and I'm going to speak in broad terms. It might not directly apply to some of the projects that are going on because that's going to be with a developer or with a contractor or organization. So it might work a little bit different. But if you're going to buy, say it was a resale of a deed restricted unit in the city of Key West, typically there's a lot of competition for those. A lot of people are prepared or preparing for when those come on the market because there's not generally a lot of those that do come on the market, so you can be ready when that happens. So say someone's selling that, they get their contract, they get a couple of contracts, they're going to look at the earnest money, what the buyer's putting down. They're going to look for a pre-approval letter, which would come after you save your money. They're going to look and see what type of financing you're getting. They're going to want to see how long it's going to take you to get that financing and when you're going to close. So, the first part, as we said, is start saving. You've got your earnest money, down payment. Your closing costs can range between 2 to 5% depending on what type of loan that you're getting. And if there's any assistance with those closing costs from the seller or any other organization that's out there. One thing you have to also budget for is continued maintenance of your property. So depending if it's a condominium or a townhouse or even a single family, that's going to depend, on how much you're going to pay for maintenance. Obviously, in a single family, is going to be the most typically out of pocket because you're paying for that all on your own. In a townhouse, you have some shared responsibility of your maintenance costs, but then you typically have the cost of your individual unit that you pay for yourself. And a condo is generally you share all the expenses amongst all the other homeowners, and that's a prorated basis based on the square footage of your unit in relation to the other unit. that makes sense to everyone. So if you have an 800 square foot unit, you're going to pay less than someone who has a 1,200 square foot unit, because it's usually a percentage of the ownership of the whole. So in savings, we generally say to set an annual savings goal and even make automatic payments. So every month a little bit goes into a savings account, or every year you put a certain amount away, because that can get away from you after a couple of years. If I meant to put in an amount every month and it doesn't happen. A couple of years later, you realize that your goal was shot and you've got to kind of start over. Credit is very, very important. There are several services out there, including if you have a credit card, that offer monitoring services that are free. There's also sites like Credit Sesame. I have a Credit Sesame account that sends me alerts all the time when things go up or down dramatically. In this day and age, we see a lot of fraud. We see a lot of people stealing your identity. So you want to make sure nobody's doing that, because that can cause a world of problems for you. And those credit monitoring alerts can kind of stop those in the beginning if you're signed up for those. If you do have a credit card, a lot of them are included in that for free. You just have to sign up for them. If you do have credit, you want to not maximize that credit. You want to keep your credit balances relatively low if you can. So 30% of your allotted credit. So it makes more sense if if you think you're going to spend X amount of dollars per month. Say it's $3,000 a month on your credit card. Makes sense sometimes to have multiple credit cards and keep those balances on each one low, and at least pay the monthly payment. And if you set those up on automatic payment, maybe even pay those a few days ahead of time, because they report to the credit bureau every month. And if they're reporting lower balances or zero balances, then you're going to end up doing a little bit better, and you're still making the same payments anyway. And once you do get under contract to buy a house, don't buy anything else on credit, especially a car. We've seen people that are approved for a loan, they're about to close, and they go out and buy a car, and say it's $200 a month. It throws all of their percentages off, because it's all based on percentage of your monthly or yearly income. So just make sure once you're under contract, don't change anything in your credit profile. So during the process, select your team and stay in contact. So that's basically your mortgage professional, number one. Number two, your tax person, or if that's yourself, make sure all of your documents are up to date and you have access to all those documents. Once once you get serious and you've got all your money saved and you're ready to identify, you're pre-approved, you're ready to identify a property, just stay in touch with your mortgage broker so that if you have new tax documents that come out, keep those in your inbox of your mortgage person, because if you need the pre-approval and move fast, like some of these resales do, you need to move really quick. And if you're looking for a resale like that, if you're working with a real estate agent, make sure you're in contact with them beforehand. And then once, obviously, you're under contract, you'll have either a real estate agent or some kind of contact, a title agent, a mortgage broker. So make sure you stay in contact with all these people during the process, the contract process. So I kind of touched on this. Things that your mortgage professional is going to need is your proof of employment, your pay stubs, your past tax returns, your bank accounts. Once you go under contracts, you're going to see that they're going to ask you for this stuff repeatedly. You're going to say, "I'll always send it to you." They're going to want it again and again and again. So just make sure you constantly update it. Every time you do pay stub, probably best just to go ahead and send it to them, because they're going to ask for it. And then once you think you send it to them enough times, they're probably going to ask for it one more time before you close. So it's just a constant verification process. And then you'll see this on your credit profile when you get it back, a list of your previous addresses. Just make sure you check that and those are yours. Sometimes I've seen it, especially if you have a common name and you have someone in the same county that has that same name, they'll start putting that person's profile in with yours. I just had that happen recently. There was a guy named like Robert Saunders or something. There was another guy. So we had the closing and he had to sign all this affidavit stuff, and he didn't want a middle initial on his title, but he ended up changing it because this other guy had a different middle initial. So, just keep up with that kind of stuff as well. And that's another reason for getting your credit alerts as well, because you just never know how these computers just lump people in together. For grants, you need to obviously understand grants. We'll talk a little bit more about the grants. Make sure you have all your financial documents available. Keep those in a folder. Go ahead and scan them, get them all ready to email to people. Sometimes, and it's not always here, but in other places, sometimes different projects have specific lenders or preferred lenders, so you might have to change lenders at some point, or there might be a product out there that certain lender doesn't have and another lender does. So even if you've been pre-approved with someone, just be prepared that you might have to switch to get yourself a better rate or get a certain program with that lender. So just make sure, if you're going to send something to someone, keep it in a file so you have access in case you need to, switch gears at some point. And once you get that, pick out a mortgage professional. Make sure you get your pre-approval and you have that ready when you're ready to make an offer on something. Because most people in this environment today won't even really look at your contract unless you have that pre-approval document from your lender. And it does help sometimes, I'm not saying always, but it does help sometimes have a local person as your mortgage professional, depending on who the seller or who you're dealing with. Because, for example, if I'm the broker in the deal and I can call someone here locally and talk to them, I like that a lot better than if I have to call Quicken Loans on a 1-800 number and they start shifting me around to different people. You're more of a number to those people than you are to someone here locally, if that makes sense. So we have some great local banks here. We have some that are national banks that have kind of local boards as well, which is good. So your contract. So these are the major parts of your contract. The contract today is the Florida State approved that the Realtors Association and the Florida Bar uses is 12 pages long. There may be, if you go into some of the new construction that's coming up, sometimes they'll have developer contracts that might be a little bit different, but they're going to have a lot of the same clauses and terms because you have to have these clauses and terms in a Florida contract. So obviously the purchase price is in there, the amount of earnest money or good faith deposit. Usually they want that in the title company or a closing attorney or some local escrow agent's account within about 3 days of the effective date. Sometimes the real estate agent holds that. Their brokerage holds it, not the agent. The brokerage holds that. And sometimes it is beneficial to go ahead and make that deposit because it can show it's already in escrow and you've already made that step. You're committed to purchasing the property. Most deals will have an inspection period. That is usually 7 to 15 days, and we always recommend you get a certified building inspector to go in and inspect it, even if it's a condo and even if it's new construction. I've sold a lot of new construction. I've never seen not one property that was done perfectly that had no problems at all. These are humans that are doing these projects and these properties. They make mistakes. There's going to be blemishes in the paint. The electrical is going to be, you push it down, it's going to come on. You push it up, it's going to go off. It's going to be reverse polarity. There's going to be something wrong. So even if it's new construction, make sure you have the ability to do an inspection once the property is completed and at least get what we call a punch list. So that's when you go in and you say, the paint's wrong here, that receptacle is not right, the light fixture is hanging off the side, or whatever the problem might be. Financing, our standard contract says that you'll apply for financing within 5 days. Now, if you've already gotten a pre-approval letter, they've already got all your documents. So basically all that is at that point is signing the actual application with the actual address of the property on the application. And usually if you don't do that within 5 days, they can void your contract. So make sure you stay up to that, because if there are multiple people looking for the same contract, same property, and they check on the financing, you haven't made it and made an earnest, a good faith effort to secure the financing, they can cancel your contract. Usually they're going to want 30 to 45 days, they're going to want a loan commitment for you. And what that basically does is also lump into the process the appraisal. So the appraisal is something that they're usually going to order once you're done with your inspections, satisfied with the condition of the property. They're going to order your appraisal, and that's something you've got to pay for up front. That and the home inspection are two items that have to be paid for upfront out of pocket. An appraisal these days is going to be probably $500 to $600. An inspection is probably going to be about the same cost. The inspection costs will also typically include any of the mitigation forms that you're going to need for your insurance. So even if you're buying a condo where your insurances are included, there's a policy called an HO6 policy. So what happens is if you buy a condo and let's just say that building catches on fire and it burns down, the building insurance is going to build that building back up. They're going to give you a vanilla shell, basically. And then you're going to be responsible for going in there, putting in your cabinets, your flooring, your walls, and things like that. So that's called an HO6 policy. That's sort of works like a renter's policy, so it's going to cover your furniture, your interior contents, and it's pretty inexpensive. It's about $600 a year. And sometimes banks require that, sometimes they don't. Title insurance is something that insures the title to your property. This is especially important on resales. That is a negotiable cost, and that's just based on the purchase price. Customarily in Monroe County, or I would say customarily, majority of the time the seller pays for the title insurance, but in multiple offer situations where there's a lot of competition, increasingly it's the buyers that pay for that title insurance cost. Typically closing, unless it's a brand new construction, is going to be about 60 days, can be 45 to 60, somewhere along that, in those lines. And then if it's a resale, you're also going to negotiate personal property, like the washer and dryer, any furnishings that are in there. Sometimes those are left as a convenience to the seller. They might be moving out of town. But all of that stuff needs to be negotiated up front, so that when you get to the closing date, you're not surprised by what's in the unit. Sometimes you could go in there, if you don't specify appliances, washer, dryer, things like that. You saw it was furnished beautifully when you got there, and they didn't say anything about furnishings. You thought it would be there, it's all gone. Those are all things that you want to know ahead of time. So be very specific on what stays and what doesn't stay. On new construction, a lot of times it comes with an appliance package, but it does not include a washer and dryer. So that'll be something that you might want to budget into if it's new construction. If it has space for a washer and dryer. I don't know what a lot of these new buildings are going to have. So the home inspection, I think we touched on a lot of this. You're going to negotiate a time in the contract to have an inspection. You're going to get your local inspector, about $500. And then during that home inspection, if it's a resale and they find deficiencies, say we just had this happen, the electrical outlets were, the GFI outlets weren't tripping, so it's a safety hazard, like in the kitchens and baths. That happens a lot. We might find sometimes even termites, whatever the case may be. That inspection period gives you the right to renegotiate your contract, or at least attempt to renegotiate your contract. Or if you can't renegotiate and you say, this isn't for me, it gives you the ability to back out of that contract and get your earnest money refunded to you. So that's very important, especially on a resale. We had a property just last week. We discovered subterranean termites on the property. Fortunately, it was a condominium, and they already had budgeted in there for subterraneans, which I was told is what we've seen flying around the past few days. Those aren't drywoods. I heard those were subterraneans. Something relatively new in our market. We've always had drywood termites, but the subterraneans have really come on strong in the past few years, and they work really quickly. They can eat through a house dramatically faster than the drywood termites that we traditionally have. So that's something very important, especially in townhomes and single-family homes, where you're responsible for that. A lot of times, we say typically on the termites, you should have your building tinted every 5 to 7 years. That termite company typically will hold a warranty for you for about 5 years, and it costs 10% of the premium. And then if they see termite activity after that, they'll come back out and retreat at no cost. But that's very important, obviously, down here, especially with what we saw in the past week with the termites coming around. I had to run from them the other day when I was walking my dog at sunset. So, what it says here, negotiate fixes or seller credits. It's another thing you can do if something's not working. Say there's a bad pipe in the bathroom, they found a leak. Obviously, you probably want to get that fixed sooner than later, but you can negotiate credits as well if it's something that isn't super important. And sometimes it's better to get the credit and do it yourself than ask the seller to do it, because they might not do it the way you would do it. Sometimes you might want the money to fix it yourself. If it's something that's not a major item. So, home insurance and monthly HOA or condo fees. I had a newer real estate agent call me today. They're confused about the difference between a condo and a townhouse because they look the same, but they operate a lot differently. Single family, you bear the brunt of typically all of your expenses, unless it's sometimes you have single family homes that are in an HOA, and then you have to do kind of double. You have to pay for all of your expenses as well as pay the HOA. But we don't have a lot of that down here. Some examples of that might be Key West Golf Course or Truman Annex, where there's some single family homes in an HOA. So in a single family home, you're going to pay for all of your insurances. If you have a mortgage, you have to have windstorm. We have 3 insurances here: windstorm, flood insurance, and what we call homeowners, also known as hazard insurance. So that covers your fire, injuries, random flooding from busted pipes and things like that. Obviously, flood is from storm surge, and windstorm is from hurricane winds. Most of the time, you're gonna pay your policy 1 year in advance, upfront to the insurance company, and then your mortgage company is going to escrow. They're going to take that money and put it in an escrow account. They're going to start paying that for you every year when it becomes due. Make sure that they pay that, because sometimes they don't pay it, and that happened to me, I think like 2 or 3 years ago. I got a notice. My wife throws everything in the trash, doesn't read it. So I grab everything and read it, and especially if it's from your insurance company, make sure you read it, because they were going to cancel me because my bank forgot to pay. So I had to get on the phone, call the bank. I already had the money, have them pay it. They're also going to be, we don't have that in here, but taxes, your property taxes in a single family, or any of these are going to be escrowed as well. So they're going to also take that money from you in a monthly payment, and then when the taxes are due, when the tax bill comes out in November here, they're going to go ahead and pay that tax bill. In Monroe County, if you don't pay by the beginning of April, you're considered late for your taxes. If you pay in November when the bill first comes out, you get a 4% discount, and then that discount goes 1% less every month until you get to the due date. So 4% in November, 3% in December, on and on and on. So you get a little bit of a discount. On the condo, your condo fees. So we talked about the HO6 policy. That's about $600 a year. That's your what we call walls end coverage. And then you have monthly assessments on your condo. That's typically all of your insurances, your building maintenance, all your common area maintenance. So if there's landscaping, if there's a pool, if there's a basketball court, if there's roads, anything like that that's not paid for by the taxpayer, you're going to pay for that in your monthly fee. It's also, if it's a big building, they probably have a management company, so that you're going to pay for the management fees as well. Sometimes in the smaller associations where, we'll have maybe it's a building in Old Town that used to be apartments and they made condominium, it's like 4 or 6 units. Sometimes the homeowners do that kind of stuff themselves, you don't have that part. And then an HOA typically is a townhouse. So, an example, if you've ever been to the Key West Golf Course, you see those kind of row houses, those are townhouses. So you're going to have an HOA fee, which is going to pay for the roads, the pools, the landscaping, the fences, that kind of thing. But then you're also going to have to pay for your own insurances and upkeep to the house, your roof, your siding, your windows, your own landscaping. So that's the big difference between the condo and the townhouse is really the building cost. In the condo, you're not going to pay for anything to do with the roof or the siding or the painting or any of that. And hopefully in your condo, banks look for this, they have enough reserves in their budget to pay for unexpected items. Because sometimes unexpectedly you do get termites. Sometimes unexpectedly you do have, not unexpectedly, but the roofs, they get old. You have to replace the roofs. You have to replace windows. You have to do certain things. So if the condo has enough money in their reserves and they can pay for that, that's great. One negative part about condos is that sometimes you get stuck with assessments where they say, all right, this roof is going to cost us $50,000. We only have 30, so we're going to spread out the $20,000 amongst everybody else. Everybody's going to pay $1,000 or whatever it might be. Which can be different. Like if you're in a townhouse, you're going to pay 100% of that, but then you're not counting on other people to make those decisions for you. You can kind of keep up with what has to be replaced and when. And that's the important part about the home inspection is they're going to go through and say, all right, your roof has another 10 to 15 years of life left in it. Your plumbing has another 5 to 10 years of life. Your HVAC has another 6 to 7 years of life. Your appliances have X amount of life. So you can kind of plan and budget going forward for, when am I going to replace these items? And we've seen a lot lately, if you watch what happened at the big building behind Publix, what's that? Santa Clara, poor management there led to a lot of things not being taken care of and led to $100,000 assessment per unit. So the board, they went through a couple of management companies. Ultimately, the management companies just resigned and stuck it to the homeowners. But sometimes things like that can happen when the homeowners aren't involved in the board and knowing what's going on. Things get negligent and don't get maintained, and then you have a situation like that. So the financing contingency gives you the right to back out of the contract and get your escrow money returned to you if you've made a good faith estimate to get that loan and you're denied for some reason. We don't see a lot of that these days, unless, like we've seen lately, we've got rates that are rising increasingly. Because what can happen is if you don't, act quickly and lock in your rate, and you let it float a little bit, and the rates go up a half a point, that can eliminate your financing because you're all of a sudden your debt to income ratio is off, and it throws off, and then your loan's no longer approved. So if that does happen, and you made a good faith estimate, and it was to no fault of your own, you lost your job, whatever the case may be, then you can typically get your escrow money back. We talked about the appraisal, so in today's real estate world, appraisal companies, banks don't know who the appraisal company is. They're not allowed to. It used to be before 2008, the bank would call an appraiser, hey, I need an appraisal on this property. They'd say basically, what do you need to come out at? And they would give them the appraisal. So now they've kind of taken that away because there was a lot of fraud going on. So now the banks put it out to a company, goes through kind of like a lottery, the appraisal comes back. And that, like I said, that's something you're going to pay for upfront. Typically after you do your home inspection to make sure you're going forward with the loan, so you don't spend another $500 or $600. It's unnecessary. So once you got your contract, got your loan wrapped up, you're going to move forward. The title agent is typically the one that's going to be holding your escrow deposit. So you're going to write the check to them, or you're going to wire the money to them, whatever the case may be. So what they're going to do is they're going to order the title work. Once again, the title insurance policy insures the title to your policy for any past claims. We've seen it before where there was a previous owner that might have had a lien that was never extinguished properly. There was never a satisfactory mortgage. Lender comes back and says, hey, you guys owe me $50,000, or whatever it might be. You have that title insurance policy and it doesn't have that exclusion in your policy, then that title insurance company is going to warrant your title and they're going to make you whole on that. You're not going to be They're going to order your HOA or condo estoppels and or your survey. So your estoppel letter just basically says, this is the amount of money that you have to pay per month. This is where you pay it. So you're going to say, for example, it might be $500 to Green Tree Condo Association. It's payable in the first at this location. They're going to get all that for you, so you have it in writing at closing. They're going to prepare the closing disclosure for your settlement statement. They're going to complete your loan package. You're going to get that from the bank. They're going to put everything in the closing statement, and they're going to go through all of the mortgage paperwork with you, have it signed and notarized in the right place. They're also going to get the loan payoff statement from the seller and make sure all of those liens are extinguished. They're going to do a lien search. They're typically going to do an open permit search, which is also important. We have a lot of contractors in Key West who are known for, once they get their check, they never close out the permits. So you have to make sure that there's no permits, because that can affect you if you go get a permit at a later date. Not always, but sometimes it can. And then sometimes banks, always banks don't like to see those open permits. So it's never a good thing when you have open permits on the title insurance. They're going to send all your mortgage documents to your lender, which is a pretty big package, probably in the area of like 100, 150 pages. They're going to record all your documents for you. They're going to put it in the correct name, the title, however you want to take title of that property. We're going to send your title insurance policy to you after closing. On a townhouse, you're going to get a survey. On a condo, you're not going to get a survey. In a condo, your condominium association documents, it's going to detail in there your specific floor plan and your square footage and your percentage of ownership out of the whole condominium. And then lastly, they're going to conduct the actual closing on the date of the closing. In today's world, a lot of people aren't physically at the closing. There's a lot of mail-aways and electronic signatures. Most banks, however, today are not honoring electronic signatures. So most times if you're getting a bank loan, that has to be a wet signature and you have to go to the office of the title company. Or if you're not in Key West or in Monroe County, it can be done with a notary, like a remote notary or some kind of means of doing it like that. So most of the closing costs that a buyer is going to pay are related to the closing of the loan. So all of these are going to have closing costs, conventional, FHA, and VA. These are the three major types of loans that we see. There's a lot of other types of loans that you'll come across, but these are the three major ones that we see. Conventional means basically you're typically putting down about 20% down payment. There are conventional mortgage loans that are less than that. But if you pay less than that, you're probably going to have to pay what we call PMI, or private mortgage insurance, which is basically going to ensure that spread between 80% of the loan and 100%. So if someone defaults, that insurance makes the bank whole, because they're going to have, if the bank forecloses, they're typically going to have costs to foreclose on that. So that pays for the bank's cost to foreclose on the property. If you do put that down less than 20%, you can get the PMI dropped. So once you've got enough equity in that property, or sometimes once a certain amount of time has passed, and that'll be detailed in your loan documents, you can request to have that dropped. You have to request it. The banks aren't typically going to just reach out to you and say, hey, you don't have to stop. You don't have to pay us anymore. Because the banks aren't really in that business. They're in the business to make money. So make sure you keep up with that. And if that's a hard date, put it in your calendar, or keep up with the equity in your property. There's also equity alerts that you can sign up for as well. It'll state, it'll send you every month and say, hey, based on the comps, your property is now worth X amount of dollars. And if you paid, say $300,000, it's now worth $500,000, you can probably drop your PMI. In the state of Florida, we have something called a SHIP loan. You guys heard of SHIP loans before?
We usually talk about that next week.
Okay.
So you can go over it real quick and then she'll
Yeah.
get more into it.
Good, because I don't know a lot about it, so
Okay.
I'll just tell you about what I know about it. So it's from the Florida Housing Corporation. You go to floridahousing.org and you can see the overview of it. But basically what it does is it gives you a grant basically to help with your down payment. So that's really the gist of it, what it is, and obviously you guys will get more into that next time. There's also some other programs that they have for Florida housing, the payment assistance and closing costs. These are the 2022 income limits for the SHIP loan. I was told the new ones come out, I think next week in April. So
It was come out in April. So,
yeah. So probably in your next class, you'll have these updated to what is current for Monroe County. It's always grouped by county, so you guys will get into more of that next time. One thing I will say, I don't know if she'll get into it, is sometimes on the properties that you buy, if it's a resale, it already has a SHIP loan, so you can qualify or assume that SHIP loan. So that's one thing to look out for. Closing costs. So this is one thing that I specifically was asked to talk about, so we'll go into this a little bit more in detail. This was something that we did on a certain example for the loss of Bahama Village. So it's all kind of based on a percentage. So you can look at the number and just adjust it to whatever the purchase price might be. So in this example, we use a purchase price of $203,000. A first mortgage loan amount was at $158,000. Interest rate was at 4%, and the loan term was 360 months or 30 years, which is pretty common for a conventional loan. There was a second mortgage loan amount of $45,000. That is in this example, that's the SHIP loan. And with that example, that brings your principal and interest payments is $754. There's no payment on that SHIP loan that's paid at the end. Property taxes are $154.29. These are on a monthly basis. We just estimated $50 for insurance, with a total of $958. So this example is on a condo. Your bank does not collect, they're only going to collect your taxes and insurance. They don't collect your condo fees or your HOA fees. So in this example, we did 3% down. Your good faith deposit would be $6,000 basically. Condo fees not included. Once again, that includes common area maintenance, all your building insurances, management fee. A lot of times we see that to be about $500 or $600 on a newer, modern building that doesn't have a lot of issues. Concrete spalling, we see a lot of here. We saw last at Santa Clara. So if you add that in, you're looking at a monthly total of about $1,500. So just in rough numbers, if you take this and you go out to $400,000, that's $2,000. You add this in, you're about $2,500. I'm gonna scale it anyway. This goes into your loan cost. So you can see on here your appraisal fee was $590. Your lender's administration fee is $11.95. That's basically just the fee that your lender charges for the cost of them doing business with you. So you'll see a lot of those kind of fees kind of go on. Your settlement fee, $600. So usually that closing fee or settlement fee is paid by each party, because the title company will charge each party for their services of coming into their building, using their time, their people, all that kind of thing. Title search fee, $150. Title insurance, $25. Title endorsement fee, $170. Recording fee, that's to record your mortgage. Monroe County, I think it's $10 for the first page and $8 for every additional page, somewhere along those lines. So you're looking at about $180 for standard size mortgage. Doc stamps and intangible tax are the two taxes that the state of Florida charges on your mortgage. Your doc stamps are 35 cents per 1,000. Intangible tax are 2 cents per 1,000. So you can see over 200,000, you're looking at roughly almost $900 in taxes to the state of Florida. That's the main way the state of Florida makes their revenue, other than sales tax, because we don't have an income tax in the state of Florida. So buyers pay a tax on their mortgage, sellers pay a tax on the amount of money they sell their house for in the state of
that money that they get from the dock stamps is actually what then goes to fund ship. So
portion
it
of
is
that.
coming back. If you get a ship loan, you're kind of getting that money back.
Yeah, a portion of that, realtors, and along with other groups, fight for that every year, advocate for a portion of that money to go into the SHIP program and other programs that the state has for workforce housing or affordable housing or whatever they're funding to. Survey fee, say this example is $900. That probably includes what we call an elevation certificate. So an elevation certificate is something you're going to need if you're in a townhouse or a single family home to get your flood insurance. So that basically says where you are in relation to base flood elevation for your area. The elevation certificate will say base flood elevation in this area is 6 feet. For an example, it might be 6, it might be 8, it might be 13 feet in certain parts of the county. Or you might be in what's called an X flood zone if you're in parts of Old Town. Near the cemetery, that whole area is X flood zone. You don't need flood insurance. It's considered to be above base flood elevation. But depending on where you are in relation to your base flood elevation, that impacts what you pay for flood insurance. So if you're above that, it's going to be less. If you're below that, it's going to be more, basically. And those can range anywhere. X flood zone, if you get insurance, it's optional. It's about $500 a year. If you're above base flood elevation, you're probably looking at $900 to $1,000 a year. If you're below base flood elevation, you're probably looking at anywhere between $2,500 to $10,000 per year, depending on how far below you are and what your flood zone is. We've got the 3 flood zones. We've got X, we've got AE, and we've got VE. So X is no flood insurance exempt, is what that X stands for. AE is what most of Monroe County is AE. So most of the property you're going to look at are going to be in the AE zone, and that's going to have a number between usually 6 and I think 11 is the highest that goes, maybe 12. Once you get past there, it goes to a VE zone. That's a velocity zone, and that's going to be the highest insurances for flood that you can get. They're also now restricting, if you're in an elevated single-family home, you can have, even a townhouse if it's elevated, they were allowing 290 square foot of enclosure below. I just read that they're going to do away with any enclosure in a VE zone whatsoever. There will be no enclosures, and I think they're going to minimize the size in the AE zone. So when I first got into real estate, I think you could have 800 or 900 square feet. Now it's got down to 290, so it'll probably continue to shrink as flooding becomes more of an issue across the United States. It's not so much here because we've always been in a flood zone, but you'll see in these crazy river flooding events that happen all across the country, to the properties that people thought would never flood, and then these rivers crest and go over. A lot of those people don't have flood insurance. They have to go to FEMA, the government. So Florida is actually known as a donor state when it comes to flood insurance. I think we've given about $20 billion over the past recent history, and we've brought in payments about $15 billion. So we've actually put money in over and above what we get back. But there's a lot of states that don't put any money in, and they get money over and above what they put in. So when you go to close, you're going to pay per diem interest. So if you close on the last day of the month, the day of closing always goes to the buyer. So if you close on, say, the 31st, you're going to pay for 1 day per diem interest. In this example, that 1 day was $17.56. On this closing, I don't remember what the date is. It must be in the link here. I don't have a date. But obviously, there were 10 days left in the month. So you're going to pay 10 days of your per diem interest. It always skips the following month. So you get kind of you're actually paying in arrears when you pay that. And then, so you skip a month, and then your payment is going to be due the following month. On the first of the month, they usually give you a leeway to the 15th before it's late. And that's where you can set up your automated payments somewhere between the first and 15th. They took the HO6 prepaid, the insurance that they took that up front, they paid the HO6. Once again, that's your walls in or your interior contents coverage on your condos. Those two together are at $775. They're going to take in advance 3 months of your hazard insurance. and your real estate taxes, and that's how they start your escrow account. And then every month you start paying that in, and when those bills come out, the bank pays for that for you on your behalf. And what are you guys going to do every year when those come out? Check to make sure they get paid. I haven't seen a problem with the taxes, but I definitely always see problems with the insurances. Also, one thing to note is your loan, your mortgage loan, typically they get bought and sold, just like any kind of item would get bought and sold. So your servicer changes a lot. So you have to make sure as you get a new servicer, you have to set up again for your automated payments, make sure they have the correct information for your insurances. Sometimes you might change your insurance company because we see some insurance companies go out of business. We see them pull out of Florida, see new ones come back in. Insurance market's always changing. After Hurricane Ian that hit Fort Myers area, we saw some insurance companies go bankrupt and go out of business. So that also changes. That's one reason why you got to keep up with making sure all that's getting paid. Because as those get changed, you might get new policies as well. So an estimated summary of the purchase, $203,000 purchase price. All those closing costs that we have here all add up to $4,679. So that's brought on over here. All your prepaids come over here are brought down here. Your estimated reserves come to $612. So that's the total here for your hazard and your taxes. That brings your purchase price from $203,000 up to $209,000. So make sure you budget for those closing costs, because in this case, that's another $6,000. So basically 3% of your cost there is your closing costs. Then you take your credits. So you got your, in this example, we didn't have an escrow deposit, so it was zero. I got my information on this from Iberia Bank. I think it's actually called now, I'm sorry, they changed their name. They changed to First Horizon Bank, which has a local branch. I work a lot with Heather at Horizon Bank. They're a regional bank, but they also have local representation, and they have what we call portfolio loans. So I told you earlier the three types of loans are conventional, VA, and FHA. A smaller subset of that is portfolio. And the three examples we mentioned earlier, usually banks originate those loans, they sell them off. So they make their money by selling you the loan. Portfolio loan is when a bank uses their in-house money, so the money they have from depositors, they loan that to you directly. They don't sell that out, and they service it directly. So sometimes on these types of properties, banks like First Horizon or First State Bank, maybe even Centennial, do portfolio loans that other banks won't do because it doesn't fit into all their check boxes. They don't really understand workforce housing on a national level a lot of times. So sometimes we have to go to these local or regional banks to get the portfolio loans.
And Heather's going to be doing the last class.
Oh, Heather is? Okay. Awesome. Cool. So she'll probably go over a lot of this with you or answer more of your questions. First Horizon does a grant in-house, so she can talk to you more about that. If you use their loan product, certain banks have certain programs like that. There might be other programs that you'll find out about through different speakers. Heather is a wealth of information about different programs for grants and bonds and different things. First responders have different types of money available. There's a Florida bond program, which I think offers $10,000. But Heather knows a lot of that kind of stuff in depth, so you'll learn a lot about that from her. Your new mortgage amount was $158,000. Your second mortgage amount, which was the ship, was $45,000. And in this example, you're actually going to get $2,000 back at closing. So a lot of times this looks really scary, but once we add it all together, it pretty much evens out a lot of times. But you're going to get you're going to get this information once you make a formal application to your lender. You have to give what's called a good faith estimate, and so you're going to get this within 3 days. They typically err on the side of caution and make the numbers as high as possible. So they're going to put every type of cost in there. So it's a good idea to go through either with your mortgage person or with your real estate agent and look at your contract and see who's paying for the title insurance, who's paying for the closing costs. Sometimes you can negotiate seller credits for closing costs. So something to discuss with your mortgage person or your real estate attorney or your real estate agent. So, low income and workforce housing options and closing costs. I think you're going to get a lot of this from other people, but we'll just kind of go over this briefly. So there's the A.H. Monroe projects, the County Community projects. Is this one you were going to speak on?
I can help you with it.
Oh yeah, this is what Sylvia said. So
Yeah.
I'll let Hannah talk about this.
Okay.
Well, you don't
Yeah,
need this.
yeah. Well, the A.H. Monroe, I believe Scott said it's going to be using conventional loans. They might recommend a few banks, like Jimmy was saying, it might be Iberia and First State, or, I don't know if they've figured that out yet, but it will be a conventional loan. You will work with the mortgage broker and a realtor, and go through the regular process. You will be able to apply for the SHIP loan, and the SHIP loan can be used to cover your closing costs and your down payment. So you will still need some money up front, but it just depends on whether you qualify for that SHIP loan and what the final cost of the homes are going to be, which we don't know those final numbers yet. So really what you are going to be wanting to do is to think about which mortgage broker you might want to work with, to be getting all of your taxes and financial documents in order. Really, no matter which of these options you're going to be doing, this is what you're going to want to do. And you're going to want to just stay on top of all these different projects. The Habitat for Humanity, it works a little differently. The SHIP loan, it also covers, if you get the SHIP loan, it also covers closing costs and down payment. For us, we don't really have a down payment, but what we want you to do is to fill up your first month of escrow. So we want you to prepay your first year. So we want you to prepay your taxes and your insurance for that first year, so that you're always ahead of the game on the escrow. So then you'll pay up that first year, and then you'll always have a cushion because the escrow adjusts the payment every year because the insurance rates go up every year. So that way you will always have a cushion, and when the rates adjust, it won't affect you quite as dramatically. So, all of these down payments, they're going somewhere. It's not like it's evaporating. It's either going to offset your loan amount or it's going into your escrow for your taxes and insurance. There's also, in addition to SHIP, the Hometown Heroes program that was started last year, which was originally for first responders. They've now expanded that to anybody that has an employer in Florida. So it's not, you don't have to be in a certain profession anymore. And I believe you can get up to $25,000 with that program now. So we will ask Marie next time if you're allowed to stack that with SHIP. I don't know if they will let you stack that with SHIP. If they would, that would be like $60,000. Or potentially $70,000, which would be really nice. But I don't know if they'll allow that or not. So there are various similarities. Working with the deed restricted properties is going to be the closest to everything that Jimmy's talking about, because that's going to be, you're going to want to work fast, you're going to want to have all your ducks in a row. These are the affordable units that Leanne was talking about. When they come up for resale, you got to act really quickly. So for that, if you want to be prepared for one of those, you want to have all your documents, you want to have your mortgage broker picked out so that you can call them and say, this came available, can I get my letter of approval for pre-qualification right away? And then you're going to want to fill out that application that Leanne gave you all at the first class, get that to Leanne, and be ready to roll with that. And if you're on top of it, you have a real chance, because a lot of people are not on top of it. So, they're all a little different, but there are similarities, and the main thing is just to start saving and getting all your documents together and start thinking about mortgage brokers and realtors if you might need one. You don't need one with Habitat. If they can do with AH, then you definitely do with the deed restricted units.
One thing about the so what Hannah said about the prepaying your taxes and insurance 1 year in advance, and then your escrow will change every year. Typically, it's going to change. It's going to go up, because one thing's for certain: the insurance costs aren't going to go down, and most likely the taxes aren't going to go down. Once you do buy your property, if you're in there by January 1st of that year, go down to the tax assessor's office between January 1st and I think it's March 31st, and get your homestead exemption. And you lock in your valuation. They can only increase it by 3% per year. You forget to do that. Talk to a lot of people that do forget to do that. It can go up 10% per year, just like it was an investment property or second home or commercial property. So you definitely don't want your assessment going up 10% per year and your taxes going up 10% per year. So that's one thing you can control, is make sure you get your homestead exemption. That homestead exemption is also portable in the state of Florida. So once you build that up over time, say you bought a property at $300,000 and when you go to sell it, you sold it for $600,000. You've got $300,000 of portability that you can theoretically take and apply. Say you retire and you move up to Central Florida, you can take that homestead exemption and transfer it up there and exempt that money from your purchase price in that next county. That's one thing that was approved, let's say 5 or 7 years ago, was that portability. So that's a big part of that as well. The nice thing about Monroe County is if you are able to buy something, and you can sell eventually, you have a little bit of equity. Typically that money goes a lot further once we retire and go to the mainland. That's why we see a lot of people that actually do that when they retire. So you take that money and move up somewhere else in Florida and live pretty comfortably on that for a while. And also port that savings on your property taxes. We do have the lowest millage rate in the state of Florida, so we have the lowest rate of taxes. We just happen to have the highest property values in the state of Florida. So kind of offsets because the county doesn't really need to have a high millage rate because the values. I just read the school board looking at 30% more revenue because of the increase in property values. So it's a tremendous amount. So you just want to make sure that you file for your homestead exemption and lock that rate. So that was my presentation. I hope you guys got some tidbits of knowledge out of that. And if you have any questions, please let me know. Anyone? It means I did a good job, I guess. You guys give me 5 stars on Zillow and everything. My card's in front of you. If you have any questions or you want to get any of this information, just drop me a line and I'll be glad to let you know anything that I know.
And next week we're going to have Marie from SHIP. She's going to be Zooming. She's the SHIP coordinator for the county, so she'll be able to really answer a lot of questions about those programs. One thing that I want to ask her is, you don't pay on the SHIP loan until you sell. It is a loan. You don't pay on it until you sell your house. But I want to know how that works, because say you've paid off your house and it's 30 years later, then all of a sudden you owe $45,000, and where are you supposed to get that $45,000 all of a sudden, So that's one question I want to ask her. But be thinking about any other, also we should ask her if you can stack hometown heroes with SHIP. And the city is going to bring back their housing down payment assistance program too. So that's something else. I don't know if she'll know about that because she's county, but that's another component to all of the assistance programs. So be working on your budgets and be working on your financial documents, and we will